Hey everyone, those of you looking for AI stocks to buy, I'm bringing you three excellent choices in this video here. Palantir Technologies, Taiwan Semiconductor, and Nvidia are all rated as buys in my list. So in this video, I'm going to compare these three AI stocks and answer which one is the best, or which one I think is the best out of these three AI stocks for investors to buy today. So let's jump right in. Let's take a look at this comparison.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the first thing I'm going to compare these three on is revenue growth. But before we take a look at that, let's take a look at the total opportunity in artificial intelligence over the next several years. According to Statista, the total addressable market for artificial intelligence is expected to grow to $1.85 trillion by the year 2030. That would be up significantly from the $207.9 billion in 2023. Artificial intelligence is popularized by large language models like ChatGPT, but there are more applications like driverless car technology, recommender systems, and more. The companies that stand to benefit from the growth in this AI surge is companies like Amazon, Nvidia, Alphabet, Microsoft, and more. Investors getting in today could realize exponential returns from investments that capitalize on the growing effectiveness of artificial intelligence. All right, so now that you've grasped an understanding of that massive market size, let's take a look at the growth prospects here. Nvidia, with 265% revenue growth in the latest quarter, that's the second consecutive quarter with over 200% revenue growth. Now, Nvidia is not going to grow at 200% for the long term, but it's going to grow at a rapid rate for at least another 6 to 9 quarters. Palantir grew revenue at 19.61%. It was the first quarter Palantir accelerated its revenue growth. You can see for several quarters Palantir's revenue growth had been declining, and you can see that slight bump upward. That's an acceleration. That's good news for Palantir and Palantir stock investors. Meanwhile, Taiwan Semi negative 1.53% in revenue in its latest quarter. Although it is improving, it is getting better. And given that Taiwan Semi is a supplier of Nvidia, its prospects look strong for the next several quarters as well. The next metric I wanted to compare these three AI stocks on is the operating profit margin. And according to this metric, you can see Taiwan Semi had been ahead of Nvidia for the better part of the last decade. But Nvidia in the latest trailing 12-month period took the lead at 54.12% compared to 45.62% for Taiwan Semi. Now, Palantir is way behind these two at 5.39%, but it's making rapid progress as you can see. Also, Palantir is only recently profitable. Around 2 decades of existence, it's now just become profitable. Management suggesting that it will generate profitability on the bottom line throughout 2024 as well. So its prospects are also improving. The next metric I wanted to consider is cash flow from operations, but I want you to understand the metric first. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Okay, so now that I've explained a little bit about what this metric is about, you can see Taiwan Semi with the big lead here at 63.15%, Nvidia at 46.11%, and Palantir at 32.01%. You can see the gap is much smaller for CFO versus operating profit margin for Palantir, and that explanation on cash flow from operations really highlights why that's the case with Palantir. And finally, I wanted to compare these three on valuation, but the metric I chose to use is the price to earnings ratio. Here's why I choose that metric. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. Okay, so now that you understand the importance of this valuation metric, you can see Palantir is the most expensive of these three, trading twice as expensively, more than twice as expensively as Nvidia at a forward PE of 62.04, compared to 27.09 for Nvidia and 16.80 for Taiwan Semi. In relation to their own histories, Palantir and Nvidia are right at the top of where these companies have traded for in the last year, according to this metric. So you're getting them at the top. However, their prospects are also much better than they've been, right? I mentioned Palantir is now profitable. It's going to be profitable. Management is saying for its second consecutive year. Nvidia, its prospects have arguably never been better. Revenue growing 200%, profit margins expanding, cash flow expanding. And you can understand why it's trading at the valuation it is. And Taiwan Semi is not trading at its most expensive. It's in fact trading at about where it's been all year long, at a forward PE of 16.8. Now, I have all three of these stocks rated as a buy, but if I had to pick one of them to buy today, I would pick Nvidia. Nvidia would be my choice for top AI stock to buy today from these three. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.